Good evening, everybody. Thank you for logging on tonight with our webinar, Understanding Financial Statements. My name is Jennifer Kenny. I'm a project coordinator over at Suffolk County Community College Entrepreneurial Assistance Center. Online with us, we have Kenya Harvey, who is also a project coordinator. She is also our MWBE specialist. We have Jay, who is controlling our live stream and recording because he is our tech guy. And we have Clarabelle Martinez, who will be doing our presentation tonight. Clarabelle, if you are ready, you can start sharing your screen and presenting.
Thank you, Jen. Let me see, let me share. Okay, let me know if you can see this.
Yes, we can see the screen.
Okay, thank you. Hello, everybody. I am Claribel Martinez, business consultant here at the Entrepreneur Assistance Center. And also I am an accountant. Today we are going to be speaking about financial statements and how to understand them. I think as a business owner, it's very important that you understand your financial statements so you have a better idea of what's going on in your business at any time. So let me just get started. So what are financial statements, right? So basically, it's basically a written record. It's like a report that you could pull up that conveys activities in your business and the financial performance of your company. So you can look up certain aspects of your company, how your company is doing when like, let's say if you want to see how much sales you had last month or last quarter or last year, or how much you're spending. You can use your financial statement to track all these things. Account balances, like, your cash balances, your inventory, things like that. They're very good at keeping track of everything in your company, right? Your financial statement are a reflection of your company's accounting, and it shows its economic structure. Your financial statements show the economic activities that are carried out in the company during a certain period. So basically all the ins and outs of everything that goes on in your company. And they usually, when your company is audited, their government agencies or accounting firms, they're going to want to look at your financial statements mainly, and also like all your business daily activities. So that's why keeping good records is a good idea. It's a great idea if you are a business owner. Is very, very important to maintain good records. And if you have, like, let's say like a program like QuickBooks or something like this, you don't have to make your financial statements from scratch. You just track your daily activities, and you can pull up the report. When you go to the report section, it will make these statements for you. So you just have to kind of understand what you're looking at. And you don't have to, know how to make them from scratch. So another thing why these things are so important, when you go to request loans and things like that for your company or credit, that banks and state, or if you're looking for somebody to invest in your company, they're going to want to look at your books. They're going to want to look at your financial statements to see how the health of the company, the overall health, is if it's worth investing in. It provides information about your company, like your revenue, your expenses, how much profit or you're making, how much debt you're in. Helps you to track your investments, right? Is your company making money or is it losing money? So you can check this by looking at your financial statements. And it's also, you can also use it for budgeting and planning and financial planning for the future. Also, like when financial analysts look at your financial statements, they kind of make educated guess of in which direction your company is heading. And you yourself, when you look at your financial statements, you can look at the past 3 years and you can kind of see like a pattern of where your company is going. And from that, you can kind of see if you need to make adjustments to have better outcomes in the future. And we'll talk a little bit more about that. So there are many financial statements, but today I just want to cover the 3 basic ones, which is your balance sheet, your income statement, and your statement of cash flow. If you have any questions, just type them in. So the first one that I'm going to speak about is your balance sheet. So a balance sheet basically shows everything that a company owns. So this is assets, anything that your company owns and what it owes. So that what your company owns are your assets, and what you owe is a liability. It is shown at a fixed point in time, and the reason for this is because a balance sheet shows account balances, as opposed to, like, let's say your income statement that you could pull up and show how much did I spend last month, or how much did I make last month, and it'll show you like a list of all your expenses, things like that. This will just show you at, like, kind of like when you look at your bank statement, it'll show you your balance as of that moment. So that's exactly what your balance sheet shows you, the account, all these accounts and the balances at this account at this specific time, like at the end of the year, at the end of the month, or whatever. So it tells you at this point today, these accounts have these balances. It provides information on your assets, your liabilities, and the stockholders' equity. Analysts use this information on the balance sheet to assess your company's risk and future cash flows. It is also used to assess your company's liquidity, solvency, and financial flexibility. This is one of the most important documents on your company, because it really shows the value of your company based on how much assets you have and how much debt you have. So this is what is called your basic accounting equation, which is your assets equals liabilities plus stockholders' equity. So your assets are economic resources that are owned by your businesses. Your liabilities are financial obligations. It basically shows all your debts, things like that. And the stockholders' equity is basically what's left, which is the owner's claim on the assets of the business. Right. So we just speak a little bit on each individual thing. So when you speak about assets, are things that the company owns that have value. So anything that the company owns, like your equipment, plants, equipment, cash is an asset, inventory is an asset, things that the company owns, your building, cars, anything that the company owns, those are assets, because either used to sell, like your inventory, you sell it to make cash, or like your machine, you use it to make the product that will make you cash. So these assets are used to help generate cash for the company. So this means that it can either be sold or it can be used by the company to make products or provide services that can be sold. So that's why they're assets, because they're used to make cash, right? Assets include physical property such as plants, trucks, equipment, and inventory, but it also includes things that can't be touched, but nevertheless exist and have value, such as your trademarks and patents. These are also assets and they have value. Cash itself is an asset, so are investments. So if your company has investments in other companies and that makes you money, that's an asset. When you look at your balance sheet, you're gonna see your assets listed right at the top, and they're gonna be listed in a liquidity order. And order of liquidity means how fast can you turn it into cash. So obviously the very first one is going to be cash because it's already cash. So it will show your cash, the company's cash balance. And right after that will be inventory, because inventory gets turned into cash every day. And then right after that will be your accounts receivable. So if your company sells on terms and gives credit, like that will be soon to turn cash. And then it goes from current to non-current. So the current, so you have a list for current on top, and then non-current means, so current means that you expect to turn it into cash within a year. Non-current is you don't expect it to turn to cash within a year. You're holding it because it is used in the company, like your equipment. Like you have your equipment that is used to make product, that's not to be sold, it's just used in the company. So those are considered non-current assets. Does anybody have a question before I go on to the next category? Okay. So then the next category on your on your balance sheet, right underneath assets is going to be your liabilities. And liability is basically debt, is how much money you owe into other companies or other people, right? So there are amounts of money that the company owes to others. Like, let's say if you took a loan out to a bank, if you're have pay rent, right? You have a lease, you pay rent, you have a contract, payroll, taxes, like all liabilities that. So it's a liability because it's an outstanding that you haven't paid it yet, right? Once you pay it, then you can expense it. Unless it's capitalized, then you will just spend a little at a time. And these are also listed on your balance sheet from the most current to the long term. So you have current liabilities, and then you have as a category, then you have a category of long-term liabilities, and your current liabilities is going to be when they're listed on by the date that they're due. So that's the ones that are due first, are listed first, and then ones that are due next, and that way you keep track of when they're due. Current liabilities, they need to be paid within a year. Long-term liabilities will be like a 10-year loan, something that you don't have to pay within this year. So, and then after that, what is left is your shareholders' equity. And so shareholders' equity is also known as owner's equity. So that's the equity of the business, right? That's what belongs to the owner. So what this means is, like, if you as an owner sold your business today and used the money that you got, you sold off all your assets, right? You sold off the entire business, and whatever money you got, you paid off all your liabilities. Whatever's left, that's your equity. It's whatever's left. That's the equity of the company. So it's basically how much the company is worth after everything, all the liabilities are settled. So it's the money that would be left in the company. So it's asset and paid off liabilities. So this leftover money belongs to the shareholders or the owners of the company. Shareholders' equity is the amount of the owners invested. So when you open up your company, like let's say you open up your company this year and you're investing money in your company, that's assets. You're investing assets, right? Cash, whatever, you're taking out money, those are liabilities. And so anything that you're investing in is part of the company. It's part of also not only assets, but part of your equity also in the company. So if there are more than one, or if you're partners, you have 2 or 3 partners, and you have to understand another thing. When you have a partnership, like an equal partnership, when one partner invest in the company, these investments become the equity of the company. So everything is pulled together and it belongs to everybody. That's why partnerships are kind of like a marriage, unless you put it in writing, right? If you have equal partnership, everything invested in the company belongs to everybody. So this is leftover money belongs to. So I think this. So I'm going to show you some examples of what a sample of a balance sheet, right? This is basic balance sheet. This is Jones Consulting Group, right? They have, here's their assets, current assets, right? In order of liquidity, they have their checking account, they have their savings accounts, they have their petty cash. Oh, this is already cash. They have 22, they have receivables, inventory, and prepaid insurance. All this is current because it will be turned to cash within a year. Non-current assets is, right? So this is the computer. This is the reason why this is negative right here is because it's considered a contra asset account, which means it goes against the asset, so it devalues the asset. So this is the asset, $7,000, and this is depreciation. So the total value of this is this minus this, right? Or your building, and then the land doesn't depreciate. So this is your assets, and this is the depreciation of your assets. So the total of your assets is with this. Land doesn't depreciate, so this is always going to be the same. Here, this is your liabilities. Current liabilities due this year. They owe accounts payable. So that means that they purchased something on credit they buy everyday business things they have with companies as they sell them on credit, and they buy it and they pay within a month or 2 months, whatever their terms are given to you. Line of credit, this year's portion, right? And then your payrolls that you have to pay when it's due. Long-term loan. So this is long-term. This is what is non-current, and here's the equity, right? Your owner's capital and retained earnings comes from years of making money. So at the end of the year, whatever money is made goes into retained earnings. So this is your total, your liabilities plus equity. See, it's 177, and it matches your total balance, your total assets. So if this doesn't balance right here, this is what they mean when they talk about balancing your books. So if this balance sheet doesn't balance, something was recorded wrong, and then you just have to go in and find out what it was. There's another example. Here are your current assets, your liabilities. So this is things that your company owns. This is debt, and this is the owner's equity in the company. Right now, you own this company. This is how much your company is worth to you. Is $25.69, right? This is all, like, let's say in thousands. So just so you know, when you look at this, I want you to understand what you're looking at, that this is, right, these are things that you own right here, and this are debt, and this is how much equity you have in your company. When you talk about equity, if you're the only owner, all this is yours, right? If you're a partnership, then it'll be, if you're equal partnership, it'll be half and half. Any questions in regards to balance sheet? Let's see. Okay. No questions? Okay, so that's basically the gist of what a balance sheet is. If you guys want to go over a little bit more in depth, or you have any questions, you always meet with me or send me an email. So when you pull up your balance sheet, like, let's say it will be a specific that you pull this at the end of the year to see your balance at the end of the year, and you could pull your previous year. You can see how the numbers have changed, right? And you could pull like every month just to see, you could see how your account balances, if your balances are going up or they're going down. And so the next one will be the income statement, which is also known as your P&L or profit and loss statement. So this is different than this because this doesn't show account balances, but it shows basically not only account balances, but by activities, right? When it comes to making money, like sales and things like that over a month or a year or a period. So it shows like the total sales over a period of time, or income and expenses is what it shows. So this shows how much money your company made and spent over a period of time. So you can pull out your income statement for the past month, the past 3 months, the past year, the past quarter, and it'll show you exactly how much money your company made for that period of time. So so it measures the success of your company operating for a given time. An income statement also shows the cost and expenses that are associated with earning that revenue. So this is basically the literal bottom line of the statement. It shows the company's net earnings or losses, right? So this tells you how much your money earned or lost over a certain period. So how is this used? So your income statement is used to determine how much profit you're making every month or every year, the value of your investment, and if you're credit worthy. So it is used to evaluate your performance, the past performance of the company. So, but you can pull up your past 3 years income statement and see has your company made 3, 5 years or whatever, and you can see like the trend of your company. If it's like, let's say it's normal, like as a new company for you to have losses in the beginning, but it's getting more and more each year, or it's getting less low. Like, you know, first year losses, second year gains, and then more gains and more gains. You're gonna see like a pattern of how the company, in what direction the company is going by studying the past year's income statements. Also, this provides a basis for predicting future performance. Just by looking at the trend, you can kind of predict where the company is going. And you can use, it helps to assess the risk or uncertainty for achieving future cash flows. So we're going to look at our income statement, and we're going to kind of study it a little bit, right? So all income statements look very similar. At the very top, you have your total sales. This is gross sales, right? Then after that, any returns. And then you minus any returns that you've had, and any discounts, right, that you've given. Like if you're giving discounts, and then this right here is your net sales. So, and you see this is a three-year comparison income statement, but you can pull this for a year, you can pull this for a month. So this company still has been steady sales for the past 3 years, 24,000, right? Then right underneath your gross sales, so you have your cost of goods sold, which is the cost associated with making these revenues up here. So any cost that's directly linked to the production of these goods is called cost of goods sold. So materials, the labor that's directly linked to production, any overhead charges, some examples, right? So this is your total cost of goods sold right here, 19,000. So you take this and you minus this, this is the gross profit right after that. Once you calculate your gross profit, and it's important to keep track of your cost of goods sold, because it helps you to notice, like if your cost of goods sold is too high, that means that you're maybe are not either paying too much for the materials, or you're not charging enough. So you need to either up your prices to better your revenue, or find a way to lower your cost of goods sold. So like, let's say if this number is too close together, right, this to this number, then you need to make adjustments. And this is where these statements help you, so you can kind of look at it and analyze and make a plan of, how am I going to fix this? How am I going to lower my costs, right? Once you have your cost of goods sold, you have to also, comes your operating expenses. So these are all the other expenses that the company has that are not directly linked with production, right? So there's just wages, like advertising, maintenance, repairs of the building, any travel, right, that you have to do, rent, leasing, deliveries, insurance, right, mileage, office supplies, depreciation, interest, and any miscellaneous expenses. So these are also everyday expenses, but they're just more general expenses instead of directly cost of goods sold, right? So this is your total operating expenses. So then you take this, you lower this, and you have this. So this is called your operating profit. So this is your profit from everyday operations. So everyday operating is like your everyday business operation. Then you can have other income that don't have anything to do with your everyday operation. Like, let's say you have money in the bank and you're making interest. So this is other income. You put that over here as other income, right? You made an investment in another business and you're making dividends. You could put it like as other income. So this is income or other income and expenses that are just not from your everyday selling and buying of your operations. And then this is the profit. So you put that here, and then this is your profit before taxes. And then after that, of course, you deduct any taxes that you've paid. And what's left is your net profit or loss after tax. So this is the bottom line right here. Your net profit or loss after you've paid all your expenses and you've paid all your taxes. So that's what's left, right? And so now this is your cash, right? Your not necessarily cash, because a lot of these are not cash, but this is your profits for the year, and this will go once you close out your year. This money goes into here as part of your equity. So this will be part of shareholders' equity. If you decide to keep it in the business and decide not to take out owner's draw and withdraw it, right? So it's whatever part of this is cash, because and then the next year you will start over recording again, because every year this goes to zero and you start recording again the next year. And then, but this is more permanent, so this is go here, owner's equity. Any questions on the income statement?
If you have any questions, you have the ability to unmute and use your microphone, if you're unable to use the chat.
Or you could type in. So this is very good. As you can see, you can keep track of how much you're spending, right? And you can keep track of how much you're making every year. And then you can also like analyze your spending every year here and see where you might be able to cut some expenses. So now, as you can see, when you study your income statement, most expenses kind of stay the same monthly. So like your rent is going to be the same every month. Mileage, you kind of drive every day, like to, you know, it's not going to be like a huge spike. So this is also a good way to check where things are being, because normally when you pull this up, let's say this is QuickBooks, you're pulling up, you can click on it, right? You'll be able to click on it, it will show you where you made the entry. Oh, today I went and bought this, and then you put it in, right? But if you see, like, let's say 5,000, and over, right, rent lease, you see 5,000 over side, and this year is 15, or is less, or is zero, that means that maybe this was categorized under the wrong account. So then you will have to go in and look at your expenses and take a look and see where it was categorized, and you can see, okay, so, but you can like take a look at this and see, does this look right? Does this look wrong? And so if you see like a spike or a dip, that means that something was entered wrong into your books, and then you just have to look for it. And you get, it's very easy to change the account. You just go in and it's like a drop down and you change the account. So yeah, and also like you can use this for budgeting. You can use this to make plans of how to make more money in the future, how to sell more. Okay, how do I increase sales? It's a very important statement that you can use. And also when you file your taxes, right, at the end of the year, this is the amount that you're reporting down here is from your profit and loss statement. This is what you're reporting. So this is the money that you made for that year, right here before taxes. And then you'll pay your income tax, and then you will record it here, and then you will have your net profit or loss right here after once you pay your income taxes. So this is very important, because this is literally when you go to your accountant, they're literally going to take all the numbers on your taxes. They're going to come from here. How much do you make your sales and how much your expenses? Most of the times, you know, this is your list of expenses or your deductions, right? When they talk about deductions, this is all your deductions right here. And then you'll report this much, and then you'll pay your taxes. Okay. So that's it on income statements. If there are no questions, I'll move on to statement of cash flows. So the statement of cash flows is very, very similar to your income statement, but the only difference is that this only tracks cash flowing in and out of your business. So as opposed to this, that lists all your expenses, right? And things that are not cash, like let's say like discounts, right? You wouldn't like put sales minus discount. You would just only report the actual cash that came in, right? And then like, let's say here, you wouldn't report depreciation or something like that, because that's not an actual cash expense. It says you keeping track of how much your equipment is worth. So when you start with your cash flow, the statement of cash flow shows the exchange of money between your company and the outside world over a period of time. So it actually just shows actual cash flowing in and out of your company and where it's used, right? So this, in the way that it shows it, it just changes. It shows a change in cash over time. So you will pull it up, it'll show you your cash balance last year, and then your cash balance at the end of the year, like at the beginning of the year, and everything that happened in between that changed that balance of that cash. So it shows a change over time rather than absolute dollars at a point in time, like balance sheet, right? It uses and reorders the information on your company's balance sheet and income statement. So in the bottom line of the cash flow statement shows net increase or decrease in cash for the period. So it shows, did you have an increase or decrease in cash for that period? So generally, cash flow statements are divided into three main parts. Each part reviews the cash flow from one of these three activities. So this is how it's broken up in these three activities. So you're gonna have cash flows from operating activities, which is your everyday operation, like your everyday business. That's cash flow that is either used to or from. And then you're gonna have investing activities. Investing activities in your company is the money that you invest in your company. Like if you buy a new machine and you spend money, that's you investing in your company. So that's investing activities. If you sell off machine and you make cash, that's cash that came from investing activity. That's considered investing activities. So that's you investing in your company. And financing activities is others investing in your company. So if you were to the bank and you take out a loan, that cash is from financing activities. Or if you get an investor that spends money in your business, that's cash generated from financing activities because there's somebody else investing in your company. Or if you go out and buy stocks in a different company with your company's name, then that's financing activities. So why is this statement important? So this statement is very important, first of all, because you have to see it like your statement is to show how much cash you have. First of all, it shows how much cash you have on hand. So can you pay your expenses? Like let's say if tomorrow something unexpected happened in your company and you needed cash, do you have enough cash to resolve it, or do you have to go out and get into more debt? So it kind of shows that portion, how stable your company is, I guess. And then if you're like, let's say if your machine breaks down, you have to go out and replace one. We have enough cash to replace it, right? So it shows how much cash. It also shows how much cash your company is generating, as opposed to like your income statement shows you if you made profit, right? Because sometimes it can look like you made profit on the books, but in reality you didn't, or it can show like that you didn't make as much profit because you expensed a lot of things that were not cash, like depreciation and things like this. But this actually shows you how much cash you generated for the company. Does anybody have any questions? I know it's a little tricky to understand, but do you have any questions? Yes, hi. Saturday.
Hi, yes, that's right. What program do you recommend that has all of these statements, capabilities to, create?
So QuickBooks is good. I heard that Google Sheets is good too. But yeah, QuickBooks is very user friendly. I would recommend it.
Okay.
And it's easy to set up too. I think we have a class, right, Jen, on QuickBooks?
Yes, we do. It's in person on Saturday, beginning in 2 weeks, I believe.
So that will help you out. And so you basically, when you get like QuickBooks, you set up your account, it will ask you a lot of questions. It's very easy to set up. It will ask you, do you have this? Do you have this? And it will, how much is the value? And then you just answer the question. It will set, once you're done answering all the questions, like it's like guided. So it's like you don't have to know exactly or be an accountant. Like it will just ask you the questions and you'll answer it, and it'll take you there, and it'll show you how to enter like your expenses and everything like that. It's very easy. Okay, so we have a question here. Oh, thank you. Okay, you're welcome.
Real quick, how many bank accounts do you recommend obtaining?
So I would say, right, your main account to track your business expenses and revenues. So you have a main account when you keep all your revenues and your, and you pay all your expenses out of it. It's easy because you can link it to your QuickBooks and it will download all the activity, and you just have to kind of categorize it. So it makes it easier for you. And I would say keep another account for your payroll, just so you can keep it separate and you can put money into it. And that way, when you pay your payroll, you can pay out of the account and you don't accidentally spend your payroll, right? And you could keep another account for your taxes, because like when you sell in New York, you have to collect sales tax, right? So every quarter, if you file quarterly or monthly, you're gonna have to pay sales tax of what you collected from the customer. So let's say if you're selling every day, and let's say you have $100,000 in sales this year, 8% of that belongs to New York State, right? So you set that money aside from the sales. So at the end of the year, you're like, oh, I spent it, now I don't have it. Like you've been setting it aside. So once you fill out your taxes, it's already there. So you just send it to them. And of course, they give you a credit for filing on time. So you'll pay that much and they'll give you a credit, and then you get that credit you can keep for yourself.
Claire,
But
David asked, what about Square reports?
I don't know much about Square reports, but I think so you could do this in QuickBooks. So let's see. So yeah, also on your statement of cash flow, there's 2 ways to keep track of it. There's something called direct method, which is basically you just keep track of all the cash that came in and out of your company for the year. So like here you go, you got cash received, and cash can mean anything, like payments you get in credit card, eventually just cash that's going into your account, and then how much cash you paid out of pocket. So this one's a little harder because you really have to be very good at keeping track of everything that comes in and out of your company. Most companies use the indirect method, which is basically you take the balance of the bottom balance of your income statement right here. Like you pull up your income statement for the last year, and you just back out anything that wasn't cash. So you take your net earnings, which is this right here, net profit, and then you're gonna back out anything that's not cash. And what's left there is how much cash you generated for that year, because you just take out anything that's cash, but left is cash. So, and the way you can check yourself is if you take the balance that you had last year in your cash account, which should be in your balance sheet right here, right? So this is your checking, your savings account, and how much you made last year, it should match, right? So you should add whatever you made last year, and then it should match the balance that you have in your cash account now. And that's how you, like you started your cash with this much in 2015, you had this much, and this year, like this should be the balance on your bank account. Does that make sense? Okay. So I'm gonna speak a little bit more about each of these activities, right? The operating investing, right? So operating activities, right, for most companies, this section of the cash flow reconciles with the net income, which is what is on the income statement. So to the actual cash that you have in your cash account. Is so in anything that is received from or used in operating activities. So cash received or used in operating activities. So to do this, it adjusts your net income from any non-cash items such as adding back depreciation expenses. So like let's say you have in your income statement, let's say this is your income, a very simple example. You made $100 today, right? And your depreciation was 10, right? In your income statement, your net profit was 90, but since no actual cash flow went out because it's just appreciation, your cash is still 100. So that's what it means by making an adjustment to the non-cash items and adjust for any non-cash that was used or provided by other operating assets and liabilities. So, and also investing is the part of investing is very straightforward. It's not really adjustments, right? For non-expense items, you just basically list, because these are things that doesn't happen all that often, right? You just list anytime you like buy some machinery, right? So this shows the cash flow from all investing activities, which generally include like purchases of sales or long-term assets such as property, plant, and equipment, as well as investment securities. So when you buy investments, that part will go there. This doesn't happen that often, so you just directly put it right there in the statement. So let's say if your company buys a piece of machinery, the cash flow statement will reflect this activity as a cash outflow from your investing activities. So it means you used cash in investing activities. So if you sold the machine, it will show cash inflow from investing activities. So it will say cash used in investing or cash from investing, gained from investing activities. So if your company has to sell off some equipment from an investment portfolio, let's say an example, these proceeds from the sales will show up in your statement as an inflow from investing activities because it had provided cash. And so that's investing. And then financing activities. So this is third party cash flow statement, shows the third part of the cash flow, but it shows the cash flow from all financing activities. So typical sources of cash flow include cash raised by selling stocks and bonds or borrowing from banks. Likewise, if you pay back a loan, that will show up as a cash outflow on your financing activities, and it'll be a deduction of your liabilities on your balance sheet, right? Which will up your owner's equity. Any questions on these activities? So like this is what it looks like. Once again, this is your operating activities right here. And you see how like last year they ended up with 43,000, right? This was right here. This is their closing balance. So, and then this is the closing balance every year. So this company has been using cash, right? So the cash has been going down. I mean, it's going up. Sorry, it goes this way. So they've been making money, right? Mostly in operating. So if you look at this, you can see this company, the everyday operations, they're making more money each year. In investing activities, it's the same each year. They're just spending $15,000, right? And here's your financing activities, very seldom. 170 here, right here, nothing here. So it will show you like the beginning of, so this is your net increase. So this is 23,000. This is the increase, there's your opening, and it'll show you what your closing bank cash is right here. So you can see very well, like, let's say how this company is doing. Just by looking at this, you can see that their operations is generating more and more cash every year, and that their closing cash balance is more and more. So they, at the end of 2018, they should have a lot more cash in the bank than they had in 2014. So and then now this ending cash flow that's on your cash flow statement should equal the cash reported on your company's balance sheet, because that's the balance on your account. So this is your balance sheet right here. That money should equal the amount here on your account. So if it doesn't match, then that means something was misreported. So that's a way how each of these statements fit together, so you could check your account balances and make sure that they're correct. So the key takeaways that I want you guys to take is that your financial statements are written records. That basically written records, they're statements, the records of your company. It shows your business activities. It shows how your company's performing. Your balance sheet shows assets, liabilities, and stockholders' equity at a snapshot in time. Your income statement basically focuses more on revenues and expenses over a period of time. How much did you make during this period of time? How much did you spend? Did you make a profit? So once your expenses are subtracted, so your sales, and you subtract all your expenses from your sales, what's left will show you if you made a profit or if you had loss for that period. And of course, then the cash flow statement basically measures cash flowing in and out of your company. What are you spending? So this is important, so you can see where your cash is going. Like, where am I spending cash in? It's very good tool to use when it comes to budgeting and watching your cash inflow and outflow. So yeah, that's it. I just if you guys have any questions, I just want to hear your thoughts. If you want to check the resources. Oh, okay. So hi, Alexander. He wants to know if you could get a recording of this. I think so. You email Jen and requesting the recording. I think they post them too, right? You post them, Jen, on
Yes, our recording is
on
going to
YouTube.
be posted on our YouTube.
So one, I just want to quickly show you this website for the SEC, because it's very, very helpful when it comes to financial statements. See if I can pull it up for you guys. And if it loads anytime today, I don't know. Let me just go to their website. Because I don't know what's going on with the I don't know what's going on. Oh, it's my computer. It's very slow. Well, I'll put it there. You guys can look it up later because I don't know what's going on right now. I'll share the links on the chat. It's very helpful. It's very easy to read. Yeah, this is a good one. So you guys,
for putting the links in the chat.
welcome. So any you guys have any okay, look at this on yourself by yourselves. The SEC is good because it's a government website. It'll show you the proper way to record things in case you get audited and things like that. And like if you go to the IRS website, also it'll show you also like last class we were talking about what's deductible and things like that, and income taxes. The IRS website has very good links for businesses. See if I can pull it up for you guys. I'll try to pull it up, but I don't know what's going on with my internet. Oh, wait, I think this one's working. So let's say if you go to the IRS, you go to, there's a portion for businesses. Right. Individuals, right? You go here. It tells you everything, all the credits that you could get for your businesses. Clean vehicle credits, right? All the credits you could claim for your business are here. So yeah, you check this out. This is a great information. You like to have it in Spanish, they have it in other languages. So it's a very good source. I'll just put it in the chat also. So yes, if you guys have any questions about the or here, I'll put my email here.
There's a QuickBooks question in the chat. It says, does QuickBooks have these statements, but in? I'm not sure what they mean by in. I guess they mean inside of QuickBooks.
So yes, so you can generate these statements from QuickBooks, but you have to have so it'll pull it up from the information that you record like every day. So when you go in and you set up your account, your company account, you'll record all your expenses, and it'll show you, like, let's say you could put it, it'll ask you questions when you're setting up, and it'll tell you what do you own, right? And you could put in what you own and how much you bought it for, and it will calculate depreciation for you using whatever you put in there, right? So like the easiest way to calculate depreciation is what's called straight line, which, let's say if you bought something for 7,000 and you want to depreciate it over 5 years, it'll take those months and it'll do the exact amount, depreciate it the exact amount every month, and you can expense that amount every month, and it'll take a whole year depreciation. But you'll just have to set yourself up, and you have to make sure you keep your expenses like the easiest way for you to track your expenses on QuickBooks is because I know you're not going to have time, you're running a business, to go in every day, every time you can make a sale and put it into QuickBooks. But if you have your bank statement and you use your bank statement for all your business stuff, at the end of the month, you can take your bank statement and match it to QuickBooks. You can even just download if you have QuickBooks Online, you can download the information directly from the bank, and it'll be generated in QuickBooks, and from that information that you give QuickBooks, you can pull up the statements. So you can pull up your expenses, and it will get all your revenue from your bank statements. And from that information, you could pull up, you could go in, and it'll say, there's like literally a button, you go generate income statement, and it'll tell you what date, and it'll generate an income statement for you. You have to be able to keep records for it to be able to generate income statement, because it pulls the income statement from the information that you are that you're recording, if that makes
From the
sense.
CVS, from the CVS files?
Yeah,
The
so
CVS, yes.
yeah, so yeah, from your file, so you're gonna have to make entries, right, in your QuickBooks. You can either make manual entries of how much you spend, like you take your bank statement and you can manually put in everything that's in your bank statement into your QuickBooks program. It's a program. So, and then yeah, it's like a you can actually download it in a PDF, or you can download it in a Word document or Excel. You have options.
Yeah, but my question is, because usually when you have a bank statement,
Mhm.
you have an option to save all your transactions, so you can
Right.
even save them as a CVS file. What I was asking is, you can import that into
It's-
QuickBooks, because I know that I can import it to Excel, and it
Yes.
just prints out, it just, gives me everything, all my activity. So you're saying that it could be imported into QuickBooks and then it can be translated into some of these financial sheets, or no?
Yeah, so you would have to link your QuickBooks program with your bank, and it'll automatically download information to your QuickBooks. Like at the other month, it like reconciles with your bank statement, and it will pull in your deposits. It will report it as revenue, and any of your expenses will be automatically downloaded to QuickBooks.
Okay. So what I'm saying is, you just can't because the thing is, the file itself, like if you go online and you save your information, it's downloaded as a
As a
CV, right,
right.
a CSV file. So you can actually take that and
Right.
just open it up into QuickBooks, because I know you can do that in Excel, and it just gives you everything. It gives you all your transactional lines, everything. So you're saying just do you either have to link the program with
Right.
the bank, or can you just download the CSV file and import that, and it'll give you the same information?
I'm not sure, if I've never done it that way, but Jay
Mhm.
knows a little more about QuickBooks.
Yeah, listen, bro, listen, David.
Mhm.
Yes.
If you are from one accounting software, you want to
Mhm.
immigrate your data to QuickBook, then you need to upload what's called the bank statement. Otherwise, this QuickBook Online, you can connect your bank account direct to QuickBook. So QuickBook
Okay.
upload direct all your transaction to QuickBook.
Okay.
Yeah, and after that, once it's connected, you will see your bank statement with the QuickBook transaction, and then you make a match. Give you a option. You click on that, match. If it's not match with your bank statement, then you will not select it as a match. It's called bank reconciliation.
Okay. Oh, bank
Once
reconciliation.
you click on match, it will come direct to
Right.
your bank to your income statement.
Okay.
Yeah.
See.
Yes, and just a reminder that we do have the class on QuickBooks, right? You want to put the information on the chat for them, Jay?
I'm
Where
sorry.
do you want to put the information for the QuickBooks class on the chat?
We do.
So-
I think we have a class we have I think in person. I don't know exactly when it's the
Actually,
schedule,
I think
but
I think I
we
have
have
that's
we have one next month or maybe, yeah. But I recommend to sit in the class and practice, because we give you access to online QuickBook. You can exercise and you can practice. You know what I mean?
It's in person, right? The class.
I believe it is, but I'm not sure. Maybe Jane, Jane and Kenya can give you information. I don't know exactly.
Yeah. Yeah, I would recommend. Hi. Mm.
Hi, so QuickBooks starts February 24th, and it is in person on Saturdays.
I'll just write it down.
And Jay, you know, it's from 10 to 12.
Oh, okay. Okay, I didn't know that one. Thank you so much.
Oh, okay, thanks.
Sorry about that. I got bumped out. I'm back in.
Was it your connection?
Yeah, my connection dropped.
Okay, so I think hold on. I think you have sent me the class schedule, right? Do you guys get the emails when the classes are coming up or no?
Yeah. Mhm.
Okay, so yeah, you suggest when you just be on the lookout for emails from Jen or from EAC, because they'll give you all the information on the upcoming classes. And I would suggest that QuickBooks one is a very good class because Jay goes very much in depth about QuickBooks and how to use it, and everything is very, very helpful.
I just put our February flyer in the chat. You can click into each class to register.
So any other questions about the class, or if you guys have any other question like accounting related, or if you guys even want me to take a look at your activities or your statements, or help you with making your financial statements or anything like that, you just send me an email and I'll be glad to help you. Or even if you like purchase like QuickBooks and you need help setting it up, I'll be happy. You come into the college, I'll be happy to help you set it up and show you how to navigate it. And also, you know, when you start keeping tracks of your finances, I can help you with your financial statement, look at your individual financial statements and help you make sense of them and understanding them. I think it's very important because once you are able to generate your own financial statements, you could just kind of bring them to your accountant, and that will save you money instead of having them do the books for you. And then you have to pay for QuickBook a bookkeeping charge, right? If you can do your own bookkeeping, then that saves you money. Do you guys have any other questions? Or comments, or, you know, feel free. Well, that's it. Then that's all for today. Like I said, this is my email. I put it on the chat. If you think of anything else that maybe sometimes you leave and you think I should have asked this, just send me an email. And I'll be happy to answer any questions.
Thank you so much, everybody, for logging on, and thank you, Clarabelle, for your presentation.
Thank you, Jen.
All right,
Thank you.
everybody.
Thank you, everybody. Have a great night.
Have a great
Good
night.
night, everyone.
Good night.